What if I told you that the world's most aggressive new artificial intelligence data broker was currently disguised as a dusty legacy newspaper?
I mean, it sounds like a complete contradiction, right? You hear the phrase legacy media, and you immediately picture like old printing presses, shrinking subscriber counts, and executives who are basically just trying to manage a slow, painful decline.
Exactly. You expect an absolute dinosaur. But today we are tearing apart the Q3 2026 earnings of News Corp.
Ticker symbol NWSA.
Right, NWSA. And we are going to prove why the market has the stock completely mispriced right now. So welcome to a special Talk Tickers style edition of our deep dive.
Yeah, and for those of you managing your own portfolios, our mission today is really simple. We're cutting straight through the Wall Street jargon.
Like a machete through the jargon. We're going to hit the headline numbers, uncover the specific business units that are actually driving those numbers, and then dissect management's forward guidance.
And of course, deliver a clear, opinionated bottom line on whether this stock is a buy, hold, or sell.
Because if you peel back the layers of this specific earnings report, you find a literal masterclass in corporate repositioning. I mean, the narrative that the internet killed the newspaper is just so outdated here.
Yeah, it's completely dead. What we are looking at today is a company that is aggressively leveraging verified data to build like an impenetrable moat in a highly volatile global economy.
Okay, let's unpack this. Because the headline numbers for News Corp's third quarter of fiscal 2026 are objectively fantastic.
They really are.
We are talking about total revenue rising 9% year over year to hit $2.2 billion, which is, a very solid top-line beat.
Definitely.
But I'm looking at the profitability metrics here, and I need you to explain this divergence to me. Revenue went up 9%, but their total segment EBITDA jumped a massive 18% to $343 million.
Right.
So how are profits growing exactly twice as fast as the actual sales?
Well, that divergence is basically the ultimate indicator of operational discipline. It all comes down to margin expansion. And for our listeners, when we talk about EBITDA earnings, before interest, taxes, depreciation, and amortization, we are looking at the purest snapshot of the cash a business is actually generating from its core day-to-day operations.
Right. So it strips out all the accounting maneuvers, the tax strategies, and like the paper losses on depreciating assets.
Precisely. It's the actual cash in the cash register at the end of the shift before the accountants start moving money around.
Makes sense.
And News Corp's overall EBITDA margin expanded from 14.4% a year ago to 15.7% this quarter. So in finance terms, that is a 130 basis point increase.
Okay, just to ground that for a second, because I hear basis points all the time. A basis point is simply 1/100th of a percentage point.
Right.
So 130 basis points is just a 1.3% increase in their profit margin.
Exactly.
Which honestly sounds incredibly small. I mean, if my local coffee shop improves their profit margin by 1.3%, they might be able to afford like an extra bag of beans for the week. Why is Wall Street cheering for 1.3%?
It's the scale. It is all about the scale. Across $2.2 billion in quarterly revenue, that tiny 1.3% increase translates into tens of millions of dollars of pure operating profit.
Oh, wow.
Yeah, falling directly to the bottom line, quarter after quarter. This tells you management is wringing significantly more value out of every single sale they make. They are scaling their high-margin digital products while basically holding their fixed costs flat.
And we see that flow right down to the earnings per share, the EPS. The adjusted EPS hit 21 cents, which is up from 17 cents a year ago.
A huge jump.
But I want to pivot for a second to how management is handling that cash. Because they didn't just sit on it, they accelerated their share repurchases in a massive way.
They really did.
They bought back $193 million worth of their own stock this quarter alone.
Which brings their year-to-date total for stock buybacks to an incredible $459 million.
Wait, hold on. Let me stop you there. I hear CEOs talk about stock buybacks all the time. Right?
Yeah.
And they usually frame it as returning value to shareholders.
Yeah, that's the classic line.
But I've always found that to be a bit opaque. How does the company buying its own stock actually put money in my pocket if I'm a retail investor holding, say, 100 shares of NWSA?
It's a great question. Think of a share buyback like a company executing a reverse dilution.
Okay.
Imagine you and 3 partners own a highly profitable commercial building. The building generates $1 million a year in rent.
So divided 4 ways, we each get $250,000.
Exactly. Now imagine the building generates a massive cash surplus one year. Instead of paying that cash out as a taxable dividend, the partnership uses that cash to buy out one of the 4 partners.
Oh, I see.
And they retire their ownership stake entirely.
Okay, so now there are only 3 partners left. The building is still generating $1 million a year in rent, but now it's only divided 3 ways.
Right.
So my personal take just jumped from $250,000 to over $333,000, and I didn't have to lift a finger or invest another dime.
That is exactly how it works. By going onto the open market, buying their own shares and retiring them, News Corp is artificially compressing the float.
The total number of shares available.
Right. They are ensuring that every single dollar of future profit is distributed across a much smaller pool of owners. And management explicitly stated on the call that they believe their stock remains, quote, materially undervalued.
Which is a bold statement.
It is. But you do not deploy $500 million in 9 months to buy your own equity unless you genuinely believe the public market is drastically mispricing the underlying assets.
So top line growth is great, and share compression is, a fantastic financial engineering tool.
Yeah.
But to know if this is actually sustainable, we have to look at the mechanics of the specific businesses. We need to look at exactly where these profits are coming from.
Right, because it is emphatically not from selling more physical copies of the daily paper.
No, definitely not. The entire narrative of this company shifts when you look at the first major engine of this quarter's success, which is Dow Jones.
Yeah, we really need to completely reframe how we think about this segment. Dow Jones is no longer just the publisher of the Wall Street Journal. It is transformed into a B2B, a business-to-business data juggernaut.
The numbers here are just staggering. I mean, Dow Jones revenue was up 8% to $619 million. Segment EBITDA expanded by 11% to $147 million.
Which is huge.
And the profit margin for the segment alone widened to 23.7%. But here is the statistic that completely blew my mind.
Let's hear it.
This marks 13 consecutive quarters of year-over-year EBITDA growth for Dow Jones. That is more than 3 straight years of unbroken profit growth.
It's wonderful.
Through inflation, through interest rate hikes, through all the global supply chain chaos, they just kept growing. How?
Well, what's fascinating here is how they have completely insulated themselves from the traditional advertising market.
Okay.
Normal media companies live and die by ad spend. When the economy gets shaky, marketing budgets are like the very first thing corporate America slashes.
Oh, always.
But Dow Jones's growth is coming from professional information businesses that are considered mission critical. So specifically, their risk and compliance revenue surged 19%, and Dow Jones Energy grew by 12%.
I have to interject here because this is the exact kind of thing that gets buried in earnings reports, but it is absolutely vital for a retail investor to understand.
Yeah.
What on earth is a newspaper company doing in risk and compliance? Like, what are they actually selling that is growing at 19% annually?
They are selling verified geopolitical intelligence. Over the last few years, Dow Jones made some highly strategic acquisitions, integrating specialized firms named Dragonfly and Oxford Analytica.
I mean, those sound like private intelligence agencies.
Because that is essentially what they are. These are elite geopolitical risk forecasting firms. Dow Jones has taken its core competency, which is the global gathering and rigorous verification of information,
Right.
and pivoted it into corporate intelligence feeds. They are selling API access to this data directly into the compliance software of major global corporations and financial institutions.
Okay, walk me through the actual mechanics of that. Give me a real-world scenario of why a company would pay millions for this data feed.
Sure. Imagine you are the chief compliance officer at a massive global bank. Let's say JP Morgan.
Okay, I'm at JP Morgan.
A wire transfer for $400 million is initiated from a subsidiary in Geneva to a shipping conglomerate in Panama. You have exactly seconds to approve or flag this transfer.
Right.
You cannot simply Google the subsidiary to see if they are legitimate.
No, definitely not.
You need to know instantly if any board member of that Panamanian shipping company was recently placed on an international sanctions list, or if the ultimate beneficial owner is tied to a politically exposed person in a volatile region.
Because if you approve a wire transfer to a sanctioned entity, the federal fines don't just run into the millions, they run into the billions.
Exactly.
The risk of being wrong is catastrophic.
It's company ending. The CFO explicitly highlighted the tensions in the Middle East and the specific complexities involving Iran during the call. In a world of extreme macroeconomic volatility and shifting international sanctions, Dow Jones provides the proprietary data feeds that automatically cross-reference these global transactions against real-time intelligence.
Wow.
the banks plug Dow Jones directly into their own operational nervous systems. It is an incredibly sticky, recurring, high-margin subscription business. Once a bank integrates this API, they almost never rip it out.
And I imagine the exact same logic applies to Dow Jones Energy. They grew 12% to $77 million in revenue, and they reported a customer retention rate of roughly 90%.
Which is exceptionally high for any B2B SaaS or software as a service product.
Right. And management mentioned this growth was driven by improving yields, new price assessments, and a modest benefit from another acquisition called Eco Movement.
Yeah.
They stated that the massive upheaval in global energy markets, specifically the surge of U.S. liquefied natural gas exports to the rest of the world, is acting as a massive tailwind.
Because, again, volatility creates a desperate, inelastic need for reliable data. If energy prices are swinging wildly based on a geopolitical event that happened like 20 minutes ago, commodities traders, global shipping logistics companies, and government regulators all need up-to-the-second pricing benchmarks.
They need the absolute ground truth to make multi-million-dollar decisions.
Exactly. Dow Jones is providing the picks and shovels for the high-stakes information age. And management's forward guidance was incredibly bold here. They see a clear path for the Dow Jones segment alone to reach $1 billion in annual EBITDA within the next 5 years.
$1 billion in pure profit just from the Dow Jones unit.
Yeah.
That completely changes the valuation multiple you should assign to this company. You can't value them like a newspaper. You have to value them like a Bloomberg terminal or a Bloomberg data feed.
100%.
But I do want to touch on the consumer side before we move on, because Wall Street Journal digital-only subscriptions were up 9% year over year. They added about 53,000 net new subscribers sequentially.
And importantly, they are flexing their pricing power. They are not just chasing subscriber volume by giving the product away for free.
Right.
They are actively working to optimize what they call their yield by raising the full price rate for a Wall Street Journal digital subscription to $44.99 a month for new customers. They are systematically decreasing introductory promotional offers and rolling out higher prices to tenured subscribers.
And people are just absorbing the price hikes. I mean, they are seeing improving year over year and quarter over quarter growth in direct subscription ARPU, which is average revenue per user.
Yeah, it just proves that if your content is essential, if it helps a professional make money or manage their personal financial risk, they will pay a premium for it without blinking.
Exactly. Which brings us to the second major engine of this quarter's success, and frankly, the one that makes the least logical sense when you first look at it.
You're talking about the digital real estate services segment.
Here's where it gets really interesting, and I am going to push back incredibly hard here, because the macroeconomic environment makes these numbers look mathematically impossible.
Let's hear it.
The digital real estate segment revenues were up 17% overall to $473 million. Segment EBITDA surged 25% to $155 million. And if we zero in on Realtor.com in the U.S., their revenues rose 10% to $148 million.
I know exactly where you are going with this. You are looking at the state of the U.S. housing market.
Yes, because anyone who has looked at a Zillow or Realtor.com listing in the last 12 months knows the U.S. housing market is effectively frozen in carbonite.
It really is.
The 30-year mortgage rate has stubbornly remained above 6%, sometimes touching 7%. Existing home sales in March were at a paltry 3.98 million annualized rate, which is near historic generational lows.
Right.
Nobody is selling because nobody wants to forfeit the 3% mortgage rate they locked in during 2021, and nobody is buying because affordability is at rock bottom. So I need you to explain the mechanics to me. If home transaction volume has fallen off a cliff, how on earth is Realtor.com making 10% more revenue?
It is the defining question for this segment. And the answer is an absolute masterclass in operational retooling. It all comes down to fundamentally changing the definition of a lead.
Okay.
Realtor.com realized they could no longer make money on sheer transaction volume. The rising tide of the 2021 housing boom was just gone. So they had to figure out how to make significantly more money on the few houses that were actually selling.
Okay, walk me through how they do that. How do you extract more money from a shrinking pool of transactions?
Well, they shifted their entire monetization strategy to target high-performing real estate agents through a premium program called Real Pro Select.
Real Pro Select.
Okay, think about the psychology of the real estate profession right now. When the market gets incredibly tough, the part-time agents, the ones who just sell a house or two a year to their friends, they drop out.
Right, they go get a different job.
Exactly. The only people left are the power users, the full-time professionals fighting for a shrinking pie. These surviving agents need the absolute highest quality, highest intent leads possible, and they have the marketing budget to pay a massive premium for them.
But what makes a lead high intent? Because in 2021, a lead was just an email address from someone who clicked on a nice photo of a kitchen.
Exactly. And Realtor.com stopped selling those low-quality clicks. They started using behavioral data to filter their audience.
How so?
They look at user metrics. Is this person calculating mortgage rates on the site? Have they saved multiple properties in a specific zip code? Are they engaging with virtual tours?
Oh, so they're looking for actual buying signals, not just window shoppers.
Right. Realtor.com takes that highly qualified data profile, bundles it, and sells it exclusively to their RealPro Select agents. By vastly improving the quality and conversion rate of the lead, they were able to dramatically increase their annual contract values with these top-tier agents.
So they're actively choosing to sell fewer leads, but they're selling them at a much higher price point to a wealthier subset of real estate agents.
Precisely. And the CFO dropped a statistic on this call that should make any serious retail investor sit up and take notice. She stated that on a trailing 12-month basis, meaning looking at the performance over the last full year, the ratio of Realtor.com's revenue to the total volume of existing home sales is over 20% higher compared to the third quarter of 2022.
Wow. Let's really pause and unpack that, because 2022 was essentially the peak of the pandemic housing mania. Houses were flying off the market in hours with multiple all-cash offers.
Right. And what she is explicitly telling the market is that today, in a terrible, severely depressed housing market, Realtor.com's financial mechanics are so much more efficient that they're extracting 20% more revenue out of every single transaction that happens than they did during the greatest housing boom in modern history.
That is wild.
We call this a structural improvement. They aren't just riding a macroeconomic wave. They have fundamentally re-engineered the economics of their platform.
And they aren't just relying on traditional buyers and sellers either. The earnings transcript showed an aggressive push into what they call adjacencies.
Yes.
They are moving heavily into new home construction marketing, rental listings, and direct seller services. These adjacencies now represent 22% of their total revenue in the quarter. They are actively diversifying the platform away from relying solely on the standard existing home sale.
Which is incredibly smart risk mitigation. Furthermore, they are absolutely winning the consumer traffic war. The Comscore metrics they released on the call were really illuminating.
I loved these numbers. Realtor.com is currently capturing 31% of total real estate portal visits.
31%.
And it's not just volume, it's depth. They are averaging 5.3 visits per unique user. Compare that to their competitors. Zillow is sitting at 3.5 visits per user, Redfin is at 2.9, and Homes.com is all the way down at a mere 1.9 visits per user.
Wow.
Realtor.com has nearly 6 times the visit share of Homes.com and almost triple that of Redfin.
Which clearly demonstrates their strategy to make the site a holistic, sticky property experience, which includes integrating AI search tools and even launching their own Realtor.com application directly inside ChatGPT, is driving significantly deeper consumer engagement.
Yeah.
And we haven't even touched on the international side of this segment, their Australian real estate business, REA.
Oh man, REA is an absolute monster of a business. Revenue grew 20% there. Part of that was admittedly due to favorable currency fluctuations, but they also organically drove a 14% increase in yield.
Right.
National new buy listings in Australia grew just 1% in the quarter, but management noted early signs of a massive spring awakening. They cited that April residential new buy listings jumped 19%. Plus, their adjacent financial services business, which handles mortgages and settlements, grew by double digits, with settlements up 21%.
So if we connect this all back to the bigger picture for digital real estate, News Corp has effectively built a highly compressed financial spring. By ruthlessly improving their profitability, upgrading their lead quality, and increasing their yield by 20% during a historic, painful housing downturn, they have fundamentally lowered their break-even point.
The upside potential here is just staggering.
It is. When interest rates eventually stabilize, and they always do, and liquidity returns to the U.S. housing market, Realtor.com is perfectly positioned. They won't just see a recovery in profits. They are primed to capture explosive exponential profit growth because their underlying engine is now vastly more efficient.
Okay, so we have Dow Jones printing recurring cash as a B2B corporate intelligence hub, and we have digital real estate defying macroeconomic gravity through ruthless yield optimization.
Yeah.
But the third major takeaway from this earnings call is arguably the most futuristic. It is the segment that generated the most colorful, aggressive language from CEO Robert Thompson.
Oh, definitely. We need to discuss the intersection of their book publishing arm and the absolute gold rush of artificial intelligence.
Let's quickly touch on the book publishing numbers first, because HarperCollins had a remarkably strong quarter in a generally soft industry. Revenues grew 8% to $555 million, actively defying broader publishing trends. Segment EBITDA was up 14% to $73 million, which marks their highest third-quarter EBITDA since 2021.
And the margin expanded by 70 basis points to 13.2%.
Right.
And what mechanically drove that margin expansion was a significant consumer shift toward digital formats. Ebooks surged 17% and audiobooks increased by 7%. And publishing digital is simply a vastly superior, higher margin product.
Because you aren't printing physical paper, you aren't paying diesel fuel to ship heavy boxes to brick and mortar bookstores, and crucially, you aren't dealing with the massive financial drag of physical returns when unsold books are shipped back to the warehouse.
Exactly. Once the initial fixed cost of producing the digital file is covered, every subsequent digital sale is almost pure profit.
And as a podcast host, I have to love the specific culturally viral drivers they called out. The CEO highlighted the feverish international interest in Rachel Reed's Heated Rivalry series, noting it's popular even in countries where ice hockey isn't a mainstream sport.
Yeah.
Thompson actually used the phrase adding 2 more voluptuous volumes to the steamy saga on a corporate earnings call. You definitely don't hear Wall Street executives talk like that every day.
No, you don't. Robert Thompson is certainly known for his rhetorical flair and his willingness to break the dry corporate mold. But underneath the humor, it highlights a crucial business reality, the power of owning culturally relevant viral IP. They also discussed a massive front list of upcoming releases, including J.D. Vance's Communion exploring his spiritual journey and highly anticipated releases from literary heavy hitters like Ann Patchett.
But as you alluded to, the books themselves are just one single piece of a much larger intellectual property puzzle. The true structural paradigm shift discussed on this call is how News Corp fundamentally views its role in the new age of artificial intelligence.
This was the absolute jaw-dropping moment of the call for me. Robert Thompson explicitly declared on the record, "We are an AI inputs company."
Think about that. Not a media company, not a legacy newspaper publisher, an AI inputs company.
This raises an incredibly important question for anyone investing in the tech sector right now. What exactly does an AI inputs company do?
Right.
Thompson laid out a brilliant mechanical analogy. He argued that the physical semiconductors manufactured by NVIDIA are inputs. The massive amounts of electricity required to run the server farms are inputs. But to make an artificial intelligence engine like a large language model actually intelligent, verified editorial content is an absolutely essential, non-negotiable input.
Because an AI model without data is just an empty algorithmic shell. To understand why News Corp is suddenly so valuable, we have to understand how these models actually work.
Yeah, let's break it down.
A large language model at its core is a prediction engine. It guesses the next most logical word based on the trillions of words it was trained on. But management made a crucial point about the type of data AI desperately needs moving forward. LLMs need foundational historical information, yes, but to remain commercially viable, they need constant, real-time, verified updates.
Exactly.
Otherwise, as Thompson eloquently put it, they are merely retrospective. They only know the past. They cannot tell you what happened this morning.
Precisely. If a user asks an AI chatbot about the geopolitical and economic implications of a sudden supply chain disruption that occurred in the Middle East 3 hours ago, the AI cannot rely on training data scraped from Wikipedia a year ago.
Right, it will hallucinate.
It will invent an answer, which destroys consumer trust. To provide a factual, synthesized answer, the AI requires real-time data injection, a process known in the tech industry as retrieval augmented generation, or RE.
Retrieval augmented generation, okay.
It needs the live, rigorously verified reporting from the Wall Street Journal or the immediate intelligence feeds from Dow Jones's Dragonfly unit, fed directly into its architecture. A few companies on the planet possess both a vast, digitized historical archive for baseline training and the immediate, globally deployed news gathering operation required for real-time updates.
And News Corp has both.
They have both in spades.
And Wall Street is finally waking up to how this mathematically monetizes. News Corp is sitting on a literal goldmine of proprietary data, and they have stopped giving it away for free. They have started aggressively licensing it. They mentioned a recent, highly lucrative deal with Meta, which complements an existing major strategic partnership with OpenAI.
Yeah, and the CFO noted that these deals are far more than purely transactional data dumps. They involve exchanging engineering insights as the AI architectures evolve.
Which means News Corp has positioned itself as a foundational strategic partner to the tech giants, not just a vendor. And the financial beauty of this arrangement is that the revenue from these API licensing deals flows almost entirely straight to the bottom line as pure profit.
Because the massive operational cost of employing the journalists, editors, and intelligence analysts to create the data has already been fully absorbed by the core consumer and B2B subscription businesses. Selling the computational rights to train an AI on that exact same archive is 100% incremental, frictionless profit.
They also explicitly mentioned selling Dow Jones AI integration rights directly to Bloomberg.
Right.
And then there is the massive legal windfall. News Corp expects to receive what they termed their fair share of a $1.5 billion settlement with the AI company Anthropic starting later this calendar year.
Which is a profound legal validation of the inherent value of their intellectual property. But what's truly fascinating is the aggressive, dual-pronged approach News Corp is taking. Thompson called it a calculated mix of wooing and suing.
Wooing and suing. I love that.
Right. They are more than happy to partner with the major, well-capitalized tech players who recognize the value of verified data and are willing to pay for it, the OpenAIs and the Metas. But they are simultaneously declaring all-out, scorched-earth legal war on the AI startups that are attempting to scrape and ingest their data for free.
Oh, the language Thompson used here was incredible. And you can tell it stems from a deep frustration with the Silicon Valley ethos of move fast and break things.
Yeah, he didn't hold back.
He called these unauthorized web scrapers dodgy digital firms scraping illegally our precious content and shamelessly reselling this purloined property. He called their crawlers baleful bad boy bots.
Wow.
He specifically targeted an AI search company named Perplexity, referring to it as the perplexing Perplexity, and noted that News Corp is actively suing them in court for what he called egregiously egregious intellectual property excesses.
He is using earnings calls to draw a very hard, very public line in the sand. He stated there is a clear legal distinction between the idoneous and the odious. The idoneous being the appropriate lawful corporate partners who execute licensing agreements for IP, and the odious being those who simply steal it under the guise of fair use.
He even escalated the threat, stating that other corporations who willingly purchase stolen, scraped content from these, quote, nefarious fencers are also legally culpable.
He is putting the entire Silicon Valley tech ecosystem on notice. Data is the new ultimate resource. News Corp owns some of the deepest, most verified data wells on the internet, and they are building heavily armed legal fences around them. If you want the high-grade crude oil to train your billion-dollar LLM, you have to pay the toll collector.
And as the CFO, Lavanya Chandrasekhar, astutely pointed out during the analyst Q&A portion of the call, this isn't just a one-way street. News Corp isn't merely selling data externally to AI companies. They're actively utilizing AI internally to ruthlessly drive operational efficiency and create entirely new product verticals.
Absolutely.
They're using internal LLMs to make Factiva, their massive legacy business research database, significantly more intuitive and user-friendly for corporate clients. They are beta testing AI for rapidly translating their back catalog of books into foreign languages and algorithmically generating audiobooks at HarperCollins, which drastically lowers production costs.
And they're utilizing AI coding assistants to allow their software engineers to deploy new platform features faster at Realtor.com and REA.
So it's a massive external revenue generator and a potent internal cost-saving mechanism simultaneously. The narrative is incredibly compelling. The past quarter looks absolutely bulletproof. But in our Talk Tickers format, we know that past performance does not pay future dividends. We always have to look ahead. What exactly did management say about the future? Because investing is about pricing in the next 12 months, not celebrating the last 3.
Let's break down their forward guidance segment by segment, starting with the macro view. Overall, executive management is expecting strong continued results in the upcoming fourth quarter. More importantly, they are projecting strong free cash flow growth for the entire fiscal year.
Just to clarify for newer investors, when they say free cash flow, they're talking about the actual cash left over after the company pays for all its operating expenses and all its capital expenditures, meaning the physical investments in new technology or infrastructure.
Exactly. So even though they mentioned they're planning some moderately higher capital expenditures to build out these new AI integration pipes, they're still generating more leftover cash at the end of the day.
Right. It shows the core business is incredibly cash generative.
Now, looking at the specific segments, at Dow Jones, they expect continued strong revenue performance and further margin improvement driven by those B2B intelligence feeds we talked about.
And what about digital real estate?
At digital real estate, as we previously analyzed, they are modeling early signs of a market thaw, specifically highlighting that 19% jump in Australian residential new buy listings in April. However, they did prudently caution that the overall U.S. housing recovery could face short-term headwinds if mortgage rates experience any sudden upward volatility.
Makes sense. At HarperCollins, they noted that publishing trends remain favorable, heavily supported by a very strong upcoming front list of new titles.
Right. The only real area where management explicitly forecasted some near-term financial headwinds was, ironically, in their traditional news media segment.
Right, the traditional newspaper publishing side. Revenue there did technically increase 5% to $538 million, but that was entirely due to favorable foreign currency exchange rates. On an adjusted organic basis, revenue actually declined 2%, and segment EBITDA dropped by $18 million year over year.
Yeah, management explained this contraction was partially due to modestly tougher advertising trading conditions in their Australian and UK markets. But the primary driver of the EBITDA drop was actually a disciplined, deliberate investment required to launch a brand new product.
The Cal Thermal Post.
Exactly, which is a highly calculated strategic move. They are actively expanding their media footprint into California, directly modeling this new publication after the cultural and financial success and rebounding profitability of the New York Post.
Interesting.
They stated on the call that they are already seeing meaningful month-over-month increases in daily user activity and digital traffic trends out west. They claim the publication is actively attracting a new tier of advertisers with what they described as its feisty coverage of local and state politics.
But they fully acknowledge that the upfront incremental costs related to staffing and marketing the California Post rollout will negatively impact the division's bottom line in the fourth quarter.
Yes.
But I noticed they immediately caveated that cost warning. They explicitly stated that the cash burn from launching the California Post should be fully offset by new incoming AI content licensing revenues flowing directly into the news media segment.
Yeah, it's wild.
Think about how crazy that is. Their traditional, old-school newspaper division's expansion costs are being completely subsidized by the artificial intelligence boom.
It is a perfect encapsulation of their modern business model.
Truly.
We also need to briefly touch on the other segment of the earnings report, which tracks corporate overhead, the cost of running the actual headquarters. An analyst on the call astutely asked about a rather large reduction in overhead losses reported this quarter.
Right, I saw that.
The CFO clarified that this specific quarterly drop was a temporary accounting anomaly related to the timing of stock-based compensation calculations. However, she firmly guided that they expect total corporate overhead for the full fiscal year to be roughly similar to the prior year and potentially even slightly lower as they continue to identify operational efficiencies.
But the absolute most crucial piece of management guidance, the specific action that ties all of this dense financial data back to the retail investor listening to this deep dive, is their capital allocation strategy.
Without a doubt.
So what does this all mean? When management explicitly forcefully states on a public earnings call that they believe their stock is materially undervalued, we have to ask, is that just standard CEO cheerleading? Because literally every CEO on earth thinks their stock should be trading higher. Or does the underlying financial math actually back up their swagger in this specific instance?
The math unequivocally backs them up, but more importantly, their deployment of capital backs them up. Talk is cheap on Wall Street. A CEO saying we are undervalued costs nothing, but executing a $459 million year-to-date share repurchase program is a massive, tangible commitment of capital. Furthermore, the CFO provided a vital, often overlooked piece of context regarding how they are funding these buybacks.
Yeah, this is huge.
She noted that these massive repurchases in fiscal 2026 are being partially funded by an approximately $380 million repayment of Foxtel shareholder loans.
Okay, let's break that down for everyone. Foxtel is News Corp's major Australian pay TV joint venture. So in the past, News Corp had loaned Foxtel a massive amount of operational cash. This quarter, Foxtel paid back $380 million of that principal loan.
So News Corp suddenly have a massive pile of liquid cash sitting on the headquarters balance sheet. And instead of taking that $380 million and doing something foolish like building a lavish new headquarters or making an overpriced, ego-driven acquisition of a failing media brand, management analyzed the entire global market.
And they looked at their own internal balance sheet and objectively decided the absolute best, highest yielding asset we can buy with this cash right now is our own stock.
Exactly. When a corporate board utilizes unexpected cash windfalls and robust free cash flow to aggressively retire their own equity, they are putting real money behind their forward guidance.
Right.
They're effectively signaling to the market. We see the internal dashboard. We see Dow Jones's exact trajectory to $1 billion in EBITDA.
We see the structural 20% yield improvements in the Realtor.com conversion funnel.
We see the massive multi-year pipeline of AI licensing contracts we are about to sign.
And we know for a fact that the public market has not fully priced this future cash flow into the current stock price.
Right.
Which brings us to the ultimate destination of our Talk Tickers deep dive. The bottom line. This is where we synthesize all of this dense data, all of these operational mechanics, and all of this corporate rhetoric into a clear, opinionated, and actionable takeaway for you, the listener.
Based on the structural mechanics revealed in the News Corp Q3 2026 earnings call, our verdict on the stock is highly bullish.
I agree. Extremely bullish. And here is the direct, actionable takeaway for your portfolio. If you are currently holding ticker NWSA, or if you're considering allocating capital to it, you absolutely must stop viewing this company through the lens of a legacy newspaper business holding on to a dying ad-supported business model.
Yeah, you have to let that go.
The broader market is still, incorrectly, pricing NWSA with a legacy media discount.
Yeah.
But the financial fundamentals clearly prove this is a highly diversified, high-margin, digital-first data enterprise.
When you buy News Corp today, you are actually buying a B2B corporate intelligence provider in Dow Jones that is deeply embedded in the compliance APIs of global banks and energy grids, growing its EBITDA at double digits for 13 consecutive quarters.
And simultaneously, you are buying a premier digital real estate platform in Realtor.com and REA.
Right.
And here's the primary macroeconomic catalyst you need to watch. We're looking at a stock that just posted 18% total profit growth while the U.S. housing market was essentially locked in a cryogenic freeze.
Yeah, it's incredible.
Realtor.com is currently thriving fundamentally in a terrible environment because they ruthlessly improved their high-intent lead yield by 20%. The catalyst for massive upside is the eventual inevitable drop in benchmark interest rates.
When the Federal Reserve inevitably cuts rates, and liquidity finally returns to the residential housing market, the volume of existing home sales will normalize back to historical averages. And because Realtor.com is now permanently extracting 20% more revenue per single transaction, their profits will not just gently recover, they will explode exponentially as transaction volume meets their new, highly efficient margin structure.
You combine that tightly coiled financial spring in the real estate segment with the pure, frictionless, free money of AI licensing deals falling straight to the bottom line across their entire portfolio of intellectual property. And the long-term growth narrative here is incredibly compelling.
It really is. The corporate transition is complete. News Corp is a verified data, real estate yield, and AI input company now.
It is truly a remarkable, stealthy corporate transformation hiding in plain sight behind a familiar, dusty ticker symbol.
Yeah.
And that leads us to a final provocative thought to leave you with today. We have spent this deep dive talking extensively about the billions upon billions of dollars that massive tech titans like Meta, Google, and OpenAI are spending on data centers, silicon chips, and electricity to build these world-changing large language models.
Right. But at the end of the day, an AI model is essentially just a hungry algorithmic engine that must relentlessly consume data to function.
And as we discussed regarding the mechanics of RAG, retrieval augmented generation, those trillion-dollar models are completely useless without real-time, rigorously verified, real-world data to anchor their responses in the present moment. So here is the question for you to mull over as you review your own portfolio. If artificial intelligence eventually requires constant, daily, minute-by-minute verified updates from legally trusted sources just to remain relevant and avoid catastrophic hallucinations, Are the legacy news companies, the exact organizations everyone confidently wrote off for dead a decade ago, are they actually the only entities holding the keys to the future of AI?
It's a great question.
Did the Silicon Valley tech giants build a multi-trillion-dollar algorithmic machine only to slowly realize they're going to be forced to endlessly rent the intellectual fuel from the old-school publishers?
It is a fascinating, almost ironic paradigm shift. The gatekeepers of the analog past might just evolve into the wealthiest toll collectors of the digital future.
It is definitely something to think about the next time you scroll past a headline declaring the death of the media industry. Thank you so much for joining us for this special Talk Tickers edition of our Deep Dive. Keep questioning the Wall Street consensus, keep looking past the sensational headlines, and most importantly, keep digging into the actual mechanical numbers. We'll catch you on the next Deep Dive.